Welcome to The Big Picture, the paradigm show where we talk about macro markets as well as micro market structure. Today, David, Joe, and I are joined by Greg, the co-founder and CEO of Gbol, which was recently acquired by Amberdata, where he now sits as the director of derivatives. So welcome to the show.
Thanks so much. Happy to be here.
Thanks. Greg, actually, for those that don't know what Amberdata is or what you guys offer, can you provide us with like a little bit of background?
Yeah, definitely. So it's basically like a holistic crypto data platform. So the Amberdata company, before we got acquired, offered market data, like spot data from a bunch of different exchanges, GDAX, Gemini, so on and so forth, as well as blockchain data that's all tagged and parsed. So you can see like Ethereum blockchain data as well as some other chains. And then you could check out like contract events and stuff like that. And then they did offer some derivatives, but now that they acquired us, they essentially sort of triple down on that division. And now we offer some pretty extensive futures and options data as well.
That's awesome. Actually, I remember when you guys first launched. I might have been one of your first customers at Gbol.
Nice. That's awesome.
Yeah, it was cool.
No, yeah, I mean it's a truly fantastic product. Not like trying to toot your horn or anything, but like, you know, I'm looking at it every day and we hear a ton of feedback from our customers. You know, we hear that like your API feeds are like top notch. So yeah, congratulations there, and we look forward to keep using the product and see you guys continue to build it out.
Oh, thanks so much, Joe. Yeah, sort of part of the thinking behind it was my background as a trader, as a proprietary trader. So a lot of the thinking are tools that I would use myself. That was kind of the inspiration for starting it. But I really appreciate that, guys.
Yeah. Actually, could you go over your background really quickly for people who don't know you?
Yeah, totally. So I started trading in 2008, just kind of as a retail with Will Warren, who actually co-founded 0x. Me and him were best friends growing up. And so I started trading like the stock market and started learning about options. And then a couple of years into it, I got hired by a family office to do some prop trading on their book. So while I was in college, I was doing that. And then I read Mike Bellafiore's book, One Good Trade. He's the co-founder of S&B Capital. Super, super good book. Highly recommend it. Ended up doing an internship at S&B Capital and going through the program and making friends with a lot of traders on that desk. And after graduating college, I came out to Chicago to trade Treasury futures. So I was trading on a Treasury basis, trading cash Treasuries versus futures Treasuries. Did that at Chopper and then did that at DRW as well. And then joined the options grain desk at DRW. And then in late 2015, decided to go crypto full time. So I actually quit DRW to trade my own book in crypto and then have been doing that ever since. And I still do that now. And then January 2020, me and my co-founder, Pat Doyle, decided to build Genesis Volatility, which was pretty much crypto options analytics that I had built in Excel VBA. Pat's got a really good data science background, and we have sort of a team that was ready to go who are really good sort of engineers to kind of migrate from Excel VBA to an actual application.
So actually that kind of segues nicely, talking about option data, into what Joe has for us today. So Joe, if you want to go over some options data for us.
Yeah, absolutely. Let me just share my screen quickly. Since we officially launched the Big Picture, and it was certainly quite a timely launch right after FTX, one of the main things we've been focusing on is how does the crypto option market look different? Like not just from like the aspect of like, oh, this is what vol skews and term structures are doing, but like more so like the microstructure, right? Like, yes, volumes are one part of it, but like what has happened with, buy side taker demand versus maker supply? Have some people stepped back? Has some people stepped up? So today I wanted to continue this, and we ran some really interesting analysis over this past week to basically look at the composition of paradigm flows over the year, and then how they've changed more recently on FTX after FTX happened. So the main takeaway, as you guys see on the screen, so inter-dealer option flow as a percentage of paradigm volume is easily at 2022 highs. which is driven certainly by FTX. So like on last week's big picture, we discussed the lower buy-side taker interest in FTX and how the option market was feeling a little bit more inter-dealer than before. But I think it's helpful for viewers to explain what exactly does that mean when I say like the market is more inter-dealer. Effectively, what it means is more buy-side takers, so like hedge funds, family offices, high net worth individuals, those guys sitting on the sidelines, and then a higher proportion of paradigm volumes occurring directly between market makers. So I discussed last week, this is how it felt, right? But what the data actually tells us could be very different from how we feel, given confirmation bias and things like this. So we wanted to quantify paradigm inter-dealer flow before and then after FTX. So moving to the next slide. So what is an inter-dealer trade? An inter-dealer trade is where both the maker and the taker on that trade on Paradigm operate market-making desks as their core business. Going back to Greg being at DRW. Let's say Genesis trades against DRW. Their core businesses are market-making businesses. But in order to hedge, resultant risk of OTC or, maybe taking views around their market-making book, DRW could act as a taker on an options trade against Genesis. A non-inter-dealer trade would be your traditional hedge fund or family office, trading against that market maker. So what we did is we looked at the population of Paradigm's trades over the course of 2022. So there were around 74,000 option crosses in the year of 2022. And then we classified these as inter-dealer or non-inter-dealer per the definitions that you see on the screen. And then from there, we calculate the inter-dealer USD notional as a percentage of the total Paradigm volume. So we do this in every month of the year. So you can see here, and then December is month to date. So you'll see, the median, it's kind of around, high 20s, low 30s is kind of where it rests. But then you see what has happened in December, and that number has spectacularly shot up, almost a 45%. So inter-dealer flow as a percentage of Paradigm volume is 43.5%, which is the highest of 2022, which is a massive jump, right? So even if we can show this on a chart right here. So typically it's around 28 to 30, December, boom, it's really, really shot up. And sure, there's some caveats here. This percentage is certainly going to partially chalk up to, it's the end of the year, right? Buy-side clients, close their book for the year. It's been a tiring year, right? People, going on vacation and just going away, stepping away, closing down the books and getting back started in Q1 next year. And sure, we're only halfway through the month. So, we'll see how this changes as we approach the holidays as well. But a jump this high, potentially suggests that there is a structural change that is going on, in the crypto option markets, at least for the short to the medium term. So it's interesting because in November, I'll just go back here quickly, right? You can make the argument well, FTX happened on November 8th, right? At the beginning of the month. Why was the November data holistically still a low percent, compared to December in terms of inter-dealer flow? Well, a big part of this is in the aftermath of FTX, takers are going to be forced to unwind their risk from exchanges or manage their positions, which is why that November 2022 number is at 30.5%, which is roughly in line with the 2022 median. But now you fast forward to December, right? And we see it. We see all the flows that the biggest institutional guys are trading in crypto option. And there is very little interest right now to add risk. And then there's also very minimal need to reposition because realized vol, on Tuesday, the 7-day realized vol was less than S&P. Greg's been around the block. That's crazy, that the fact that it's this low. And we talked about last week, why this might be. And sure, the vols are very low, but that's just due to largely an apathy in the market. People just aren't trading, right? So the question is from here, like what's going to happen, right? Like, are buy side takers going to come back, or are people still very concerned around custody and until solutions like that can be figured out? Like we mentioned like copper as a potential solution on last week's podcast, or like are we going to be basically kind of sitting on our hands where like crypto really doesn't do anything until like the macro continues to improve, like what David will certainly talk about, and then we actually get that bull market run, the next bull market run, and then the interest comes back. But until then, are we in a new normal? Maybe. I hope not. It's certainly not good for the market. It's never really good when you don't really have a lot of buy side takers adding risk, and then you just have market makers trading, term structure and skew with one another at like close to mids. Like that's not a recipe for people, to make money and want to stay engaged. But we'll see where it goes. We'll continue to monitor this data, through Q1, and hopefully that this percentage goes back down to that median of 28-30%.
Yeah, Greg, actually, I want to jump in really quick and get your take on that. As someone, like Joe said, who's been around the block a little bit, like what are you seeing right now when you're looking at the data and when you're looking at crypto option markets?
So kind of just commenting on the vol and something that Joe just touched on. So after the FTX kind of blowout happened, I was very like, I don't want to sell vol even though it's high. A lot of my thinking is like this. Vol is mean reverting. So the obvious trade is always the expensive one to carry. And when vol is high, it's almost better to buy it because something might actually happen. And when vol is low, it's actually one of the times that's the most expensive. And we see that right now. Like you could see, if you look on the chart on the right-hand side, you can see the variance risk premium being really wide in most of December. And that's a low vol environment, and people are willing to bet that something's going to happen and it's going to mean revert, but they're prepaying for that right. And so it ends up being one of like the best trades. And so I kind of think nothing happens until year end. To me, that's the most logical thing to happen. There's a lot of seasonality, holidays, the big numbers are behind us. It's kind of coast is clear until year end. I think 2023, who knows? One of the big themes in my mind is that we're going from an environment where it's easy money to an environment that's not easy money. And this is the first time crypto has traded in that transition. And so we'll see how that goes. But that's kind of how I'm thinking about it and what I'm seeing in vol right now.
Yeah, it certainly seems to be the view from the paradigm community that for the rest of the year that it's just vol is just going to be in the doldrums. Like we saw some guys, certainly people weren't like buying up a ton of gamma into the very highly anticipated CPI or FOMC. But there was some, right? Like people weren't going to be leaning too short into this. But since that, like yesterday afternoon, this morning, people have just been absolutely dumping, like the December 23rd and December 30th buckets, right? I mean, you look on this picture on this left, right? December 23rd is now trading at a 35. It's trading around 35, right? I mean, I've never seen it that low. I mean, I've only been like really involved in crypto vol for around a year, but like, pretty insane to me. But then again, your market's not realizing, right? Like it's very easy to just look at a chart. Oh, implied vol's at all-time lows, but then you kind of realize why that is, and like realize sucks, and there's a reason why realize sucks because there's a lot of apathy in the market, and people just really aren't trading. So I tend to agree with Greg that it's going to be quiet for the remainder of the year, which is why I got my holiday sweater on. I'm already in holiday mode.
Joe, is there a trade there that makes sense to kind of take advantage of like the short-term sort of low vol, but still be positioned? Obviously, there's so many risks around still that things could blow up, like calendar spreads or anything like that. Are there trades that you look at that you think that could work pretty well? That kind of covers you in this sort of the front end vols, but also if things do blow up.
Yeah. So one thing that we've seen a lot of our customers doing, and I think that makes sense. Like, it's very easy to say, like, oh, vols are at the lows, just trade outright puts, but, like, realize sucks. And like carry is just pretty nasty. I mean, you've seen even just after the event how much like the implied realized vol spread has really come in. But what's interesting actually when you look at skew, sorry guys. When you look at skew, right? Like of course like skew has come in quite a bit, but like when you look at the level of skew, so when I say skew, like the difference between the implied vols in this case, of the 15 delta put versus the 15 delta call, when you look at what that value is relative to the absolute level of implied vols where we're at, which is basically all-time lows, it still is like fairly steep. So when I think about like put spreads, like, ideally, I would have the ability to basically look at the 90% put versus, maybe the 85% put, because what I care about is more so the downside skew. But I'm just kind of using the 15 delta put call as a proxy that skew is still fairly steep. In which case, when vols are low and, the skew is still relatively steep for that environment and, carry is certainly an issue, you definitely want to reduce some of that. So I think put spreads are likely the way to go. I wouldn't be. I mean, we've seen some of it, but I mean, I'm not a big fan of the 1x2 selling two of the downside. At this point, those short Vega trades when implied vols are at what 35, 40. I don't know. That doesn't really make sense to me. But I think put spreads probably make the most sense right here. So something like a January like 95, 90% put spread. I would need to really look at the payouts to kind of see what would make sense, but something like that probably screens pretty good right now.
1x2s used to be my bread and butter, but actually I would like to.
You get blown out? You get blown out?
I've never gotten blown out. I've never gotten blown out. My man, I've been blown out other ways. NFTs, yeah, I got blown out on some NFTs, but not 1x2s, not yet anyway. But actually, I would like to pose the same question to Greg. Like, Greg, what are you doing right now, like in this environment?
Yeah, so I got a couple things on Bito, which is like the Bitcoin futures ETF. And so what I have there is I do actually have a diagonal January, March, long to March puts, short to January puts. I put that on a few weeks back, or maybe about 4 weeks back. And my thinking there was we still had pretty high vol in the short dated stuff. And I kind of think 2023 is going to be nuts. So my thinking is vol dies down in the front months, and then something happens in March. And then I actually own some outright put. This is just a delta bias, but just some big Bito June puts at $11, which are pretty much a couple cents in the money. That's just pure delta. I basically think like Bitcoin has to test lower levels. It wouldn't make sense to me that it doesn't.
Oof, that hurts.
Sorry.
and Greg, what's your main rationale for that?
Just basically the fact that we're going from like an easy money environment to sort of a restrictive money environment, and sort of the risk premium that you used to have from like basically lending out stable coins in the crypto space was like earning 9%, and the 10-year treasury was earning 1%, and now the 10-year treasury is earning 4%, or a little shy of that, but give or take. And then a lot of the stable coin lending trades have blown up. So I just think there's so much unknown that I wouldn't want to be at this pivotal moment long crypto right now. I think easy money has found its way into like speculative assets, and I really like crypto, and I totally believe in like the fundamentals, but I think short-term speaking, like there's probably just more downside.
Yeah, it's interesting.
I'm in the bottom for tough stuff, right? And look, I'm not running a hedge fund where I need to report like a NAV to my investors, or evaluation to my investors, once a month, right? Like if I have the view that like crypto is going to be higher, 2 years from now, like sure, there might be more downside down to 12, but if we 2 years from now, if we're back up to even 30 or 40, like I don't care, being able to pick the bottoms is certainly easier said than done.
For sure. Joe, I'll cut this part out, but do you have any more slides you want to go through?
No, I'm all good. I'll let David take it away. Certainly a lot to talk about there.
But by the way, I can hear you guys all right. I've got this complete distortion in terms of like you're delayed in terms of when I'm seeing you speak.
Oh shoot!
It'll be okay. We'll fix it in post. So hopefully, yeah, we'll be able to fix it.
David, I'm curious to hear your opinion. It sounds.
Sorry, Greg, say again. It is a little bit different. It is a little bit different. I mean, I guess that's a good segue into sort of speaking a little bit about what I'm thinking on the macro. I mean, it's curious, Greg, because you said about your downside bias being about we're sort of moving into this regime of tighter money, right? I've kind of been of the view, and am of the view that that's what we've been trading this year, right? We've seen probably the sharpest tightening cycle in all recorded history from the Fed. And particularly when you look at it in terms of percentages from where we've come from, definitely the tightest cycle we've seen. I kind of think and a theme that I've been talking about for the last few weeks is this kind of, I'm kind of sensing this underlying shift in the macro dynamic where we're actually moving away from pricing that tightening to now kind of pricing what comes next. And there's a lot of talk about, pivot, pause. And I'm kind of like, I think that misses the point for me. And the point is we've spent all of this year pricing this tightening cycle. It's been super aggressive. And we're now coming towards the end of that, right? So, I mean, we had the Fed last night. I mean, markets have kind of sold off in the back of it. I kind of felt the bar would be pretty high for them to be hawkish. I actually think it's a bit of a knee jerk around it. But my kind of takeaway was like, they're going to end the hiking cycle in June, right? In March, right? They pretty much said that. It looks like they're going to go. The terminal rate's going to be, I think they got like 5.1%, so a bit higher than what they said, and then they're going to keep it there longer. But then, like, they're curiously in 2024, they see 100 bips being sort of slashed off of that cycle, but. That's all kind of, okay, semantics. The Fed are typically wrong with their forecasts, so they're kind of not really worth too much to pay too much attention to. But the takeaway for me is like, look, we are now pricing the end of this hike cycle, which comes in March pretty much. How long they keep it there, whatever. I think basically markets now start pricing this transition to the end of the hike cycle and then to when they start cutting. And what I'm looking at, which I think is interesting and I've been talking about, is the dollar's starting to sell off. Rates look like they've topped out. Even after yesterday, and I know we're in this little risk off today, 10-year yields have come lower, 2-year yields are coming lower. So the dynamics change where it was kind of the rates market was kind of leading the sell-off in risk assets as yields were going higher and we're trading the inflation trade. We're now pricing the kind of recession trade. We kind of peak inflation. We had that soft CPI number the other day. That's kind of fed the idea that we're past the peak inflation hump, and we're now worried about growth and recession. But that's a vastly different sort of the impact cross asset is vastly different when we're pricing growth risks to inflation risks. So what that means for me is essentially duration starts to perform, and we're seeing that, right? 10-year yields are coming lower. They've kind of stalled a little bit and they've been a little bit volatile around this level, but I feel they're going to break lower. So long durations to start to perform, 10-year, 30-year yields come lower. And I kind of think that's really important for crypto, because ultimately crypto is the longest duration asset. So I think the rate dynamics change quite a lot. I also think if you look at from a liquidity perspective, I kind of think we're at the sort of lows in liquidity provision to these markets, or what's been drained out of them. The reasoning for that, I mean, M2 growth has collapsed this year. And that tends to start to sort of bottom as economies start to hit recession, because we start to see easier policy. China credit impulse is ramping up, and that tends to be a bit of a lead on M2 growth as well. So I just think you're starting to see that even within so the Fed for all their QT. You're starting to see some of the money that's parked in the reverse repo, right? We've got over $2 trillion parked every night at the Fed. Because of the high money market rates, that's now starting to be teased out and come back into the market. So you've got the reserve repo sort of starting to come down, only slowly at the moment, but it's coming down. You've got ahead of the debt ceiling, you've got the Treasury are kind of running down their balance at the Fed, the TGA, the Treasury General Account at the Fed. So to keep it really easy for our listeners, if RRP is going up, if the TGA is going up, that's kind of a draining of liquidity. As those things are coming down, you kind of add in liquidity. And we've seen those things coming down. So I kind of think liquidity is improving. I think we're going to see sort of the dollar selling off is kind of easier financial conditions. So I kind of think we're going to be in a better liquidity environment into 2023 than what we've had to suffer throughout 2022. So I've been tentatively saying, look, I think we could be at the lows here. I think what drives us lower in crypto is going to be another blow up, more dead bodies floating out from the post FTX. And, there's a lot of FUD going around at the moment still, which is, again, natural once you've had an event like we have. So I think if anything drives another push lower, I think it's going to come from something like specific to crypto and someone else blowing up and just that kind of false selling dynamic that's kind of been weighing on things. I actually think the macro has changed as we start to price the end of this cycle, this hike cycle, and there's signs that the liquidity cycle's turning higher as well. So I think we'll be in a lower rate environment, as in yields across the curve come lower. I think duration rallies, and I think that ultimately supports us here in crypto, and maybe sets us up for the next move higher.
Yeah, that's super interesting. And I actually don't disagree on the duration part of it. I just think that it may be duration's a good buy from the different angle. So my thinking is like raising rates, especially really fast like we did, there's a lag between when you raise rates and when it impacts interest rate sensitive industries. So there's a little bit of a lag there. And we could see actually duration outperform because of recessionary forces. So I just kind of wonder, like, for example, I just bought this house in July of 2021, and my rate's 275. And right now, the 30-year rate's over 7. And I just think, what happens when like the housing market starts to slow down? Obviously, construction is a very interest rate sensitive factor of the economy. And I also think as long as the unemployment rate is low, like that definitely gives leverage to the Fed to do whatever it wants. Like once the unemployment rate starts to tick up, now they sort of got to make a decision. I don't think we're there yet. And I think that can actually, like, who knows? I don't know much about inflation or calculating CPI at all. Like that is not my strength. So, I'm talking a little bit beyond my pay grade on this, but, why couldn't just the low unemployment rate keep wages high and keep them competitive? And at that point, like the Fed is still, even if they don't raise rates, but just hold them longer, you're still discounting future cash flows, and that still has an impact. And I think at some point, there has to be some sort of like tick up in unemployment that does make duration a good buy. And I also think, just from a technical perspective, the way that Bitcoin is performing right now doesn't provide a lot of confidence in me. Like we traded down to 20. 20 was a big level for a long time. It was like the 2017 high. Everyone's looking at that level. We broke through it, and then we get back to it, and just it flatlines. And then we break 20, and we're at 15, and now we're kind of flatlining, give or take a few grand here as well. No one's like jumping in hands first to buy this market. I don't know. It doesn't have a lot of confidence in me. It doesn't like provide a lot of confidence.
Yeah, I see that, and I think one of the things we're battling at the moment is this negative flow dynamic, right? Because you're still getting a lot of false selling, and as we kind of unpick the bones from FTX, we still wait and see what's going to happen with Genesis. So and there's been a lot of people hurt, right? They've had to unwind businesses, unwind positions. So I think the flow dynamic is still negative, right? That's kind of weighing. But if you look across to like NASDAQ, S&P, like other kind of risk assets over the last sort of month or so, right, and they're back low. But we had a decent rally. It's kind of stalled out a little bit now. But that looks a lot more sort of positive. I mean, what from the CPI number back last month, we had a really sort of decent rally, and then we've kind of held. It looked like we were going to push on the other day, and then the Fed have kind of killed that a little bit. So I think other asset classes starting to perform, and I say the dollar for me is always key to everything. And an old FX guy, I always think the dollar sniffs out regime change, and also look, it's the dollar wrecking ball, right? It causes problems, it sucks liquidity out of all markets. And weighs on everything, and the dollar's selling off quite a bit. So, I mean, put another way, and I'd ask you, Greg, maybe like if we didn't have FTX, and given where like Nasdaq and other stuff's trading, given where dollar's trading, I mean, where do you think Ethereum or Bitcoin would be right now if it wasn't for the FTX blow up? Because it looked early November that we were about to really start breaking out to better levels, right?
Yeah, that's a good point. I don't know. I still think consolidation, and I totally agree with you on the dollar. I think the dollar is a big stress point, globally speaking. Like if I just look at a dollar yen, that's Japanese macro is my favorite thing in the world. Most indebted country in the world, interest rates go to a couple percent, can't even cover interest costs alone with all the tax revenue. That is like the ticking time bomb of the world, of the Western world. So you need the dollar to come down so that situation gets better. You can't have the yen trade at $250 yen. But we're seeing the dollar come off because like also the ECB is raising rates. And so, maybe that's part of the interplay. It might be like sort of deflationary interest rate hikes abroad that are affecting that dollar trade. Totally agree with you. If the dollar comes off, that's really good for the more bullish perspective. On the risk assets side, just technically speaking, or like from a technical analysis perspective, I don't like this S&P chart. To me, it's still clearly in a downtrend. I mean, we're at the top of a range of a downtrend, but it's not a chart I would be wanting to buy.
Yeah, and it's always. I mean, we've spoken on here. It's always difficult as well when you're trying to call a bottom on stuff. So it can be a thankless task. And again, it's for me. It's I still kind of feel like we've seen the lows, certainly in crypto. I kind of felt that way. I'm surprised actually post FTX we didn't make new lows, and in certainly in Ethereum, Bitcoin. So I think that's kind of encouraging. But I say I do think like it's just stepping back, that we're looking at quite a different macro environment where we're going into a world where we're going to start looking at the end of hike cycles and then starting to think about the cuts that come. You've already got the Eurodollar curve is pricing in cuts, I think 125 basis points of cuts through the end of next year. And when we start pricing that, I just think things look a little bit different. And then look, we're going to be a little bit data dependent. I mean, looking at inflation, again, without going too much into depth around that, but the three things the Fed are kind of looking at, they're looking at sort of goods inflation, they're looking at housing data and the housing parts, and then core services, ex-housing. The core services ex-housing is a bit they're really focused on, because they've kind of acknowledged that we're in a goods disinflation environment and our supply chains have eased. Housing, they've kind of acknowledged that that's a massive lag in input, the way they calculate it, and like owner equivalent rent. And so it's quite clear that that's going to drop out the numbers. So in fact, if you actually took out the housing sort of part, we've actually been looking at sort of deflation in the US. So there's lots of signs that inflation is actually going to fall pretty sharply once they start taking out those things. Yeah, to your point, point taken. Labour market still looks pretty strong, although again that's probably the most lagging indicator. And I always say that the housing market is the up the elevator down the up the stairs down the elevator shaft in terms of. When companies make cuts, they do it in big swathes and then they hire more slowly. So I think the cuts are coming. A lot of activity data and that would suggest that's in the pipeline as well. So I think now and then what does that mean for risk? And then crypto's a high beta risk asset. So yeah, there's lots of things at play. I just think the macro dynamic is changing. I think the dollar's telling us that, and I think the fact that duration looks like it's going to really start to rally and rates and yields are going to come lower, I think that's a more supportive environment that potentially allows us to call a bottom on this stuff.
Yeah, well, that's awesome. I mean, you definitely know your shit. So,
yeah, but do we go to like you say the rate cuts happening, but like, is this because like, I think it matters. Like, are we going to be engineering a soft landing, or is this just going to be like every other recession, right? Like, I mean, just look at the revisions on the summary of economic projections, right? Like the core PCE, the September projection has gone from 3.1 to 3.5. The unemployment has gone up as well. Like, there's been a very downbeat forecast on the labor force participation rate. So like, I look at these projections, and like, so Jeffries has a forecast out. They said that, given like the labor force participation rate, I mean, they're forecasting 1.6 million job losses next year, right? Like, that's very significant with like no rate cuts, or no rate movement. That's what they're saying. So like, I don't know. I just think it's going to be difficult, and like, if we're cutting rates because like we're going into recession, like I don't think that the bottom is in just yet. But once we do sort of establish that, then yes, we can start going up again. Like it's very hard for me to wrap around like, okay, we're going to go into a rate cut environment, and then like Fed is able to get everything under control, right? Sure, like inflation is moderating, but like if it moderates around like 4.5%, 5%, where it is, or whatever, right? Like, I don't think that's going to be enough for them.
And rate cuts.
So like, they go on.
And then rate cuts can come from the recession. That's the point that I'm stuck on.
Yes, I'm with you.
Yeah, I guess, and this is maybe controversial, I guess, but as a macro guy, it took me a long time to get over this post 2008, the idea that we're now more a function of rates and liquidity. And I think people obsess over like recessions and not. I got bullish risk like mid 2020 when the Fed come out and said we're doing unlimited QE, and I'd kind of been waiting for that moment for a lot of years, because like the next time we have a crisis and the Fed come out doing unlimited QE, I'm just getting long everything, right? And they did it, and I remember when they did it, and talking to other hedge fund guys, and they thought I was nuts. They were like, we're going to be facing the deepest recession, post-wartime recession, right? We're looking at depression territory. The world is shut. How the hell can you be bullish here? And because we're a function of rates and liquidity, and it's as simple as that. We got the recession, all right. It was short lived, and we got the V shape or whatever. But markets ramped to like record highs pretty quickly as well, because they just turned the liquidity hose on and rates went to zero pretty quick. So I'm kind of that view, and I think the Fed have created that, unfortunately, where they've artificially inflated assets. The Bank of England, only a few weeks ago, were back intervening in the gilt market. So I just feel like recession's not the big risk off. I think the big risk off, if you want to think markets price ahead of themselves, I kind of feel like we've priced it a little bit, and once we're in a mode where we're pricing easier policy and more liquidity, then I kind of think you're going to see a lot of these assets recover, and 2023 looks a lot better than we've looked in 2022.
Me too, but
maybe talking my own book here, big time. Maybe we need it. We're exhausted, man.
Anecdotally, talking about labor markets and stuff, if we do happen to lose 1 million jobs next year, or whatever the projection was, I know of 5 McDonald's around me that are paying $18 an hour right now, $18 to $25 an hour. So if you want to work at McDonald's, you can. We'll have jobs somewhere. So let me get your final thoughts on what's going on. If you could sum up what you just went over in a couple sentences, David, go for it.
Yeah, so I think my final takeaway, even after the Fed, is that we're moving into a macro environment where we're going to be pricing the end of the Fed hike cycle, possibly pricing cuts into the tail end of next year. So I think the rate outlook looks different. It looks like duration's starting to perform, so yields are coming lower, the dollar's selling off. And it looks like because of all of that, the liquidity cycle is changing as well and turning higher. So I kind of think we're at or near the bottom of the liquidity cycle, which I think turns higher. And then I therefore think risk assets generally, and particularly high beta crypto, is going to perform better throughout 2023.
Cool. Greg, final thoughts. Go.
Well, I like David's 2020 call. about the unlimited QE. I think that definitely makes a lot of sense. I think we're in this environment that we've just done that a couple of years ago. And so the Fed balance sheet is like $8 trillion or whatever it is. David, is that the right number?
But, yeah, it's around that, right?
So I think we're in that position where we already have like this liquidity out there. And until we have a real recessionary move or like a spike in unemployment or anything like that, we can allow them to like roll off their balance sheet and contract a little bit. I think that's part of the picture. I think the fact that we raise rates so fast has a lagging effect. We'll see how that plays. And then lastly, I do think there's a turning point as well in the globalization. Like we're going from a globalized world to a deglobalization world. Who knows how that affects everything? So I just think there's a lot of moving parts, and I don't like this Bitcoin chart at all. I don't want to buy it.
Oh, Greg, just turn it the other way. Turn it upside down.
Yeah, you just have to inverse it. Yeah. Joe, go for it.
Yeah, in my view, as I mentioned on the beginning chart, right, interdealer option flows are certainly dominating most of the crypto options market right now. And to kind of segue onto what Greg and David said, maybe that doesn't change until the macro environment does get a bit easier. Whether that's due to a soft landing or a hard landing, and then we get into the next bull cycle. So you have that as a potential overhang, and people not wanting to really step into the asset class, especially if it's your first time doing it. But also certainly a lot of like the custody sort of issues that we've previously discussed. And until we can figure out that problem with centralized exchanges, or until enough time has passed where people feel comfortable enough to dip their toe back into the pool, this could potentially be the new normal for a while. I don't have a crystal ball. We'll see. We'll monitor the data. We'll let you know.
Perfect. Joe, you can't not be bullish when you're wearing that jumper, man.
Bullish for our holiday party. I think we might be the only crypto company in New York that is hosting a holiday party. I would imagine most have canceled, so I guess we at least have that going for. Marketing budget is still there.
That's awesome. Well, guys, this was a lot of fun. Thank you so much, Greg, for coming on, taking the time to hang out with us. And I guess that's the show.